Hi everyone and welcome to chapter 14. It is relatively an easy chapter as compared to whatever we have done. So this chapter consists of employee stock options. So let's start. So nature of employee stock options. Employee stock options are call options that are issued by company on its own stock. They're often at the money at the time of issue and they can last as long as 10 years. So what I'm going to do is I'm going to open an Excel, explain you that concept, and then we can move ahead. Okay. So employee stock options are generally call options issued on company stock. So these are call options that are issued on company stock, right? Generally when they are issued at the money. They are issued at the money, right? So strike price is fixed. Exercise or strike price is fixed. Let's call it strike price is fixed today. So employee stock options are essentially call options that a company issues on its own stock, right? When they are issued, they are generally at the money. Strike price is fixed today. Generally the duration is 10 years. And there is a concept of vesting date, which is generally after 4 years. Okay. They are mostly issued by startups, but big companies also issue them, but they're mostly issued by startups, right? And they are a kind of reward for companies' employees. Okay, they are kind of a reward for companies' employees. Now, what is difference between a normal call option and employee stock option? The difference is when the option is exercised, company issues new shares. When the option is exercised, company issues new shares to the employee. So how does this option work? So let's say I join a startup. So I joined Airbnb, which is currently not a listed company. And because I'm doing a fantastic job, Airbnb says, like, with a notional stock price or notional strike price of $100, it will give me 10 employee stock options. With a notional strike price of $100, it will give me 10 stock options, employee stock options. Now they are saying the vesting date is 4 years. So before 4 years, I cannot do anything with that options. So if I leave my job, I do away with my options. Okay, before 4 years, those options are not vested. So I cannot use those options till 4 years. After 4 years, I can start using them. Okay, so I can exercise after 4 years and duration is 10 years. So after 10 years, I have to exercise. Okay, I cannot keep them beyond 10 years, but within 4 to 10, from the start of vesting date to the start of duration of option, I can exercise them anytime. So what is exercising? Exercising means that I have a right to buy Airbnb at $100 irrespective of market price. I have a right to buy Airbnb at $100 irrespective of market price. Now, why does Airbnb give these options? They give the options because then I'm encouraged, right, to see that Airbnb succeeds. Because if an Airbnb succeeds, right now the price is $100, but if Airbnb succeeds in 10 years, that stock could be valued as much as $10,000. So I have an incentive that is tied up with long-term success of a company. That is the reason startups or generally companies give employee stock options. Okay. Now they also mention that if you leave before the vesting date, you give up your right on options, and if you leave before exercising, you can only sell those options to the company. You cannot sell those options in the open market. So if Airbnb is listed after 4 years, it is doing currently an IPO. So if Airbnb gets listed, I cannot sell my employee options on the open market. I can only sell it back to the company if the company wants to buy. Okay, so I cannot sell those employee stock options even after they are vested out in the open market. So it is internal thing that the company does. So these are employee stock options. Now, if you look at accounting treatment of options, so for company, it is treated as an expense. Employee stock options are expensed in the income statement for a company, right, when they are granted. So not when they are exercised. When they are granted, the value of that option is calculated and it is expensed. For an employee, it is treated as a reward. So you may have to pay tax on employee stock options when they are exercised. Okay, so this is the basics of employee stock option. They are essentially a call option issued on company stock. They are generally issued at the money. Strike price is fixed today. Duration is 10 years. Vesting date is generally after 4 years. They are mostly used by startup companies to reward their employees. Okay, and when option is exercised, company issues new shares. It is unlike a call option on the market. When you buy a call option on the market, the writer gives you shares. But in this case, the company creates new shares when the options are exercised. Okay. So let's go back to presentation and cover it. So there is a vesting period during which options cannot be exercised. When employees leave during the vesting period, options are forfeited. So you cannot take them with you before the vesting date. When employees leave after the vesting period, in the money call options are exercised immediately and out of the money call options are forfeited. So if company doesn't grow and options don't have value, then they turn to zero. But if the company is growing and options have value, then you can exercise them after the vesting date. Employees are not permitted to sell these options in the open market. When options are exercised, the company issues new shares. To realize cash from employee stock option, the employee must exercise the option and sell the underlying share. So to realize the benefit of this option, you have to exercise it, get the share and then sell it in the market. Even when the underlying stock pays no dividend, an employee stock option, unlike regular call option, is often exercised early. So we have discussed call options, mostly American call options. There is no incentive to exercise early because you have to then buy the stock, right? It is more beneficial to sell the option rather than exercising it. But employee stock options, you cannot sell it. So it is better the only way out is to exercise them. Drawbacks to employee stock option. Gain to executive from good performance is much greater than penalty for bad performance. So options are like zero sum. Like if the employee performs bad, the option just goes to zero, right? He doesn't lose money. His incentive is not tied. But if the performance is good, then you create, like, he can multiply his wealth. Executives do very well when stock markets as a whole goes up, even if their firm is doing relatively bad. So also employee stock options are based on stock prices. So even if the company is not doing good, but the market is good, then the executives can benefit. Executives are encouraged to focus on short-term performance at the expense of long-term performance, especially if a stock option is coming towards maturity. So let's say maturity of stock option is in 6 months. So if I am the CEO of the company, I have some options and they're getting matured in 6 months. So what I'll try to do, I'll try to boost up the stock price as much as possible. So whatever good news is there, I'll try to create good news for the company so that the stock price goes up. So it's an incentive for short-term performance, not long-term performance. Executives are tempted to time announcements or take other decisions that maximize value of options. Accounting for employee stock options. Prior to 1995, the cost of employee stock option on income statement was its intrinsic value on the issue date. After 1995, a fair value had to be reported in the notes, but expensing fair value on income statement was optional. So right now the options have to be mentioned at fair value. You have to expense it out at fair value. But before that, you just have to mention the intrinsic value. If they are in profit, they have intrinsic value, otherwise they don't, right? And even in 1995, when the rule came out, there was a lot of lobbying by Congress, right, not to do it. So it was suggested to make it fair value, but it was not made mandatory. But after 2005, the rules have changed and fair value of options has to be charged on income statement when they are issued. The attraction of at the money call options used to be that they led to no expense on income statement because they had zero intrinsic value on exercise date. The other plans were liable to lead to an expense. Now that accounting rules have changed, now you have to expense them out. Companies are considering other types of incentives. There are few other incentives. Strike price is linked to stock index so that the company's stock price has to outperform the index for options to move. So there are different ways that companies, so biggest threat of employee stock option is even if the company is not doing well, but the market is doing well, then the employees benefit, employee stock options benefit. To counter that, what are companies doing? They are saying that you have to beat the market to make any money. So if market is going up 10% and your option is going up 10%, then you don't get anything. But if you beat the market, if your firm's performance is better than the market, then you make money. Strike prices increases in a predetermined way. Options vest only in specific profit targets are met. So this was given to Elon Musk by Tesla. Tesla said that you get X number of employee stock option, but you have to meet some sales target. So if sales target are met, like let's say 500,000 Tesla cars, then only you can take those options. You can exercise those options. So such conditions can be put. Now, how to value employee stock options? You can use Black-Scholes-Merton model that we discussed in the last class with time to maturity equal to an estimate of expected life. There is no theoretical justification for the time to maturity adjustment, but it does seem to means it is followed in practice. So what do? You calculate the average time an employee takes to exercise the option in past. Use that time to value current option, and we use Black-Scholes-Merton model that we discussed in the last class to do that. You can also use more sophisticated approach like binomial trees that we discussed last class. Okay, they have given an example. A company issues 1 million 10 years ATM option. Stock price is 30. It is estimated that long-term volatility is 25% and average time to exercise is 4.5. So you do not use the total time because you don't know when the options will be exercised. You use average time in Black-Scholes-Merton model. The 4.5 years interest is 5% and dividend has a present value of 4. So in Black-Scholes-Merton model, 30 is the stock price. You have to subtract dividend from it, present value of dividend. So 26 becomes S0, K is 30, R is 5, sigma is 25% and T is 4.5. So there are steps to Black-Scholes-Merton model that we did in last class. So option price becomes 6.31. So income statement will show 6.31 million as expense. Okay. Because 6.31 is one option price, you are issuing 1 million options. So 6.31 into 1 million is 6.31 million. Dilution. Employee stock options are liable to dilute the interest of shareholders because new shares are bought at below market price. However, this dilution takes place at a time the market hears that the options have been granted. So whenever there is news in the market that employee stock option have been granted, the stock price goes down because people know that new shares would be issued in future. So the price of stock goes down. It does not take place at the time options are exercised, but when the news comes out. Backdating. Backdating is an illegal process in which executives backdate the strike price of the option to the lowest stock price in the given period. So let's say I'm a CEO of a company. I want to benefit from options. So what I'll do, whatever options I'm giving to myself, I'll backdate them to the lowest price in last 6 months. And I'll say it in the income statement that I got options at that price. Okay. Backdating appears to be a widespread practice in United States. A company might take the decision to issue at the money options on April 30th when the stock price was 50 and then backdate the grant date to April 3rd when stock price was 42. Why would they do this? To benefit, because exercise price is 42 and the current stock price is 50. So rather than issuing them at the current stock price, which is the legal way to do it, they can backtrack it and give the options to employees at a price which is lowest in last 6 months. Academics have shown that stock prices on grant dates are on an average lower than on the subsequent 30 days. So what does it say? That whenever stock options are granted, that price generally is the lowest price in the last 30 days. So employees are using backdating a lot, right? That is what this research shows. This could not have happened by chance and led the SEC to require stock options grants to be reported within 2 business days of the grant date. Backdating has led to numerous lawsuits. Who loses and who gains when the grants are backdated? So shareholders generally lose when options are backdated, because if company, it's an expense. So whenever company expenses out options, right, shareholders lose money. Shareholders' profit goes down. So that's it. It was a short chapter. Okay. See you in the next chapter.